What's going on, guys? I wanted to jump back on here, give our quarterly market update as we round out Q1. The markets have been exceptionally volatile, so wanted to add some light to that, what we're thinking over here, give some historical references to how often this really happens in the market and what we can do, during down market times, how we can turn this actually into a positive thing for your portfolio. So, quick, just kind of update on everything else that's been going on. March Madness just finished up. I'm still repping the U of A. Still a little bit depressed that U of A went out in the Final Four. It was an amazing season. Talking about college basketball here, obviously, if you're not familiar or didn't really watch March Madness. But this was potentially one of the greatest University of Arizona basketball teams I have seen in a long, long time. Obviously, growing up in Tucson, we had season tickets and have been U of A fans forever. So it was a great season that they made it so far, but also so sad that they lost right at the end, this close to getting to play for a national championship. It was, but great, great year watching. And then the Masters going on this weekend. So pretty fun, couple weeks here in the sporting world. I'm actually headed down to Tucson this coming week, going to meet with all of my clients down there. So for all of you guys down there, I've already reached out and we'll be getting together to review your portfolios. And then once I get back from Arizona, I'll be reaching out to everybody else to have you send me your tax returns. Hopefully those will all be done. And then set up our next 6-month review. We'll be going over your taxes and some other strategies and things. So that's what's been going on. That's what we'll be looking forward to here moving into the next couple months. So back to the market. It's been volatile. I know, obviously, I'm sure you guys are aware, the war has been, of course, the big leader in this. And that's the hard thing. I mean, like I told you guys, it's interesting thinking about, what we talked about a few months ago in our last market update video. I told you that I thought this year was going to be more rocky. I didn't know there was a war coming, of course. That's the greatest risk to the stock market is the unknowns. I mean, we can't control when there's going to be a war or if the Strait of Hormuz is opened or not. I mean, I don't have the power to change those things. You don't have the power to change those things, right? We don't know when that's going to bring on more volatility. But just with how high valuations were, I kind of thought there would have to be some sort of a little pullback, and we've been seeing that. But the market has been just going up and up and up, just almost in a perfectly linear fashion for so long now. It feels like a little bit of a gut punch here, and it can be a reminder that volatility is normal, and that we're not always going to get just positive returns every single month. But fear not, we have a game plan. That's why we build the financial plan. That's why we talk about your goals. This is not a concern to me. Everything is going to be okay. But let's look at the numbers because they are, serious. So I ran this first historical performance from January 1st to March 30th. Around March 30th is when the most recent lows hit. So the Dow at that point in time was down about 6%. S&P was down a little over 7%. The NASDAQ, which again, we've been talking about, the tech index, has either been the biggest leader or the biggest loser here in the last few years. So NASDAQ was down about 9%. I threw a couple different stocks in there I wanted to look at. We don't have direct exposure to these. We have a little bit of exposure to these within some of our mutual funds, but I think it's interesting to look at because, a lot of these tech stocks in the Magnificent Seven have been absolutely on a tear, and they're kind of getting hit the other direction now. So Apple was down a little over 9%. Meta was down 18.6%. Tesla down 21%. Microsoft down 25% just in Q1 of this year. So those are some serious numbers, and some serious cause for concern. Obviously, we didn't have 100% of our portfolio in Microsoft, thank goodness. But for people that were overexposed there, they're feeling a lot of pain at this point. And that's why we talk about diversification, right? That's why asset allocation is so important because it's not an if, it's a when. There's going to be market pullbacks. There always will be market pullbacks, and there will continue to be market pullbacks going forward. But with proper diversification, we are able to weather these storms. So this is where it gets interesting, guys. This was, again, January 1st until March 30th, where it could start to feel like, holy cow, is the bottom falling out of this thing? Do we need to start panicking? All right, now I'm going to change to just year to date. Today is April 9th as I'm recording this video. If you would have sold during these around April or March 30th, when everything was at its lows, you missed this giant rebound that brought everything back up almost to positive territory. We're having another good day today. When I woke up this morning, markets were down, and all of a sudden there's some more talks about a ceasefire, which is rallying the markets even further. So now we'll just work bottom up this time. Microsoft year to date down about 23%, Tesla down 22%. Still, those two companies have gotten beat up pretty good. Apple down 4, Meta down 4. The NASDAQ trying to creep back to positive territory, down about 1%. S&P down marginally, 17 basis points. The Dow is actually positive 0.5%. So crazy to think with everything that's going on this year, the market's getting close back to even. And that brings me to my next point. Historically, this happens all the time. It just feels crazy right now because we've been having 20 plus return years, just boom, 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 one after another. And then all of a sudden we get used to that and feel like that's the norm. That's not the norm. I was doing a little bit of research here. So basically, the S&P at its lowest was down a little over 7%. Historically, 5% pullbacks in normal markets on average happen 3 times a year. 10% pullbacks happen normally around once a year, and 20% pullbacks happen every 5 to 7 years. 10% normally happens one per year. So technically, if we're just going to go on averages, we still haven't even hit that 10% yet. On average, we should still see another 10% pullback this year. And that's okay. Volatility is not a bad thing. Remember, I talked about if there's volatility in your portfolio, you should be excited because that means we have enough firepower in the portfolio to outlast inflation and provide better returns for you over the long run. So I really think that's an important thing to think about. We hit, down 7%. NASDAQ was down 9, but the S&P was down 7.3% right there. You can see that blue S&P. That's not even in the 10% territory, which should happen once a year. The 5% should happen 3 times a year. We should get 2 more of these throughout the year in a normal market cycle. So I think it's good to just take a step back. Remember that this stuff is normal. I know a war is a different circumstance here, but whether it's a war or inflation or bad unemployment numbers or whatever the boogeyman looks like at that time, these pullbacks are normal and will continue to happen for as long as you invest in the stock market, and that is okay. All right. So truthfully, this is before I move forward. Sorry. This is the other crazy thing that people tend to forget about, right? We tend to be so short-sighted with our behavioral and how we're thinking. Again, I was talking about this in the last video with loss aversion. The thought of losing $10,000 hurts way more than the pleasure of potentially gaining $10,000, where everybody tends to have much more loss aversion. So that's why we feel that in our gut right now, where it's like, man, this year's been absolutely brutal. But look at just a 1-year trailing period. So from April 9th of 2025 until April 9th of 2026. Okay, just 365 365 days back from today. Okay, we're just looking at the major indexes here. Dow is up 19%, S&P's up 25%, NASDAQ's up 30%. Still, even with this war, even with oil prices going crazy, even with gas prices being astronomically high, look at where we're still at over a 1-year time frame. So we have to remember to keep the long term in mind. That is what is the most important with investing, because that's what allows us to be disciplined. When we lose our discipline and we start going to speculation and gambling, trying to time these things, that's where it's absolutely impossible. I did not get a phone call from President Trump saying that he was going to call a ceasefire on Iran and that the market was going to jump today. I don't think any of you did either. So we can't time, we don't know what's going to happen. We have to stick to our guns, stick to our proper asset allocation, stick to our diversification, and talk about when you're going to need this money in the long term and be goal oriented. That's how we're going to be successful. So as we're thinking about that also though, there is a possibility that there's going to be more volatility from this war. It's not even, things haven't gotten great. They just got less bad. So it's not like, hey, we're in the clear and we're just going to soar towards 20% return throughout the rest of the year, and we're never going to see a down day until looking into 2027. That's not the case. There will be more market volatility with this because there's going to be more stuff that happens with the war. So if we continue to have, a potentially more down periods, what can we do to take advantage of those and turn it into a positive? The first thing that we can do is tax loss harvesting. So for all of you guys that are using non-retirement accounts, we talk about this in our meetings. Remember, you are taxed on an annual basis based off of any realized gain. A realized gain is only when we push the sell button, not when you take money out. A lot of people think, oh, I don't get taxed, I take it out. That's not true. It's when you push sell. So if you bought Apple $100 worth and it goes up to 400, if you never push sell, there's no taxes. The second you push sell, you're getting taxed on that $300 capital gain. So what we can do is throughout the year, if there are some more losses generated, we will push the sell button to lock in those losses. That way, that will help bring down any gains closer to zero to limit your tax liability. Also, you can use $3,000 worth of capital losses, of realized capital losses against ordinary income per year. So if we generate, let's say, $50,000 of losses within a portfolio, you can use 3,000 of that towards your income, and the remaining 47,000 you can roll forward into future years indefinitely until you use all of that up. So we can do a lot of things to help make sure that in one potentially bad year, if this turns out to be a bad year, we lock in these losses and help offset future taxes when there will be gains later on. So that's a really important step and something that we'll be keeping a close eye on as we move forward. Doing Roth conversions is also a great thing during down markets because, again, when we do a Roth conversion, we're taking money from your traditional IRA, converting it into your Roth, paying the tax now, letting it grow tax-free forever. Well, if you have, let's say, $100,000 in a traditional IRA, and if that fell to $50,000, you would still own the same number of shares, but we would be paying half the amount of money to actually convert those shares into your Roth. So then you're paying less taxes, and as the market rebounds, it will grow exponentially faster inside of your tax-free account, which is what we want. So if the market continues to have some issues, I will be talking to a lot of you guys about maybe taking advantage of steeper Roth conversions than we were originally planning. The last part that's a great thing about volatile markets are all of you guys that are dollar cost averaging, which a lot of people are putting money into their accounts on a monthly basis. The great thing about doing that is if we look over this last year, you've been buying stocks throughout this whole entire time. So I always tell you guys, everybody runs out to their Black Friday sales. They want to go buy all of their clothes on discount, their whatever it is. They want to buy it on discount. But when stocks go on sale, they feel that they're not worth it, and they want to do the opposite. People always want to buy stocks at a premium. It's just a behavioral thing that we have. So for everybody dollar cost averaging, you've been buying the same companies, if we're talking about Tesla, all during this time at cheaper and cheaper and cheaper prices adding to your portfolio, so that when these different mutual funds and companies rebound, those dollars will rebound exponentially faster. Your overall cost basis will be lower. So there's a lot of things, again, that we can do to take advantage of these down markets. This is normal. I can't stress this enough that we have to stay disciplined during these times. But of course, if you have questions and want to review, which we're going to be doing anyways, it's time for our 6-month review. So I'm going to be reaching out to everybody. But always feel free to reach out in the interim if you do have other questions. All right, so let's jump into the quarterly value add that I sent out. I want to share a different screen here really quick with you guys. So let me move over. Okay, guys, so especially with everything that's going on in the market, I always tell you, we can only control what we can control, right? And we can, regardless of what's going on in the stock market or wars or volatility or whatever, we can make sure that we do a good job with your tax planning, your estate planning, your insurances, all these other things that are going to save you money over time, and be as important, if not maybe even more important than the actual mutual funds and things that we're picking within the portfolio. So one of those things that I wanted to cover, and this is the quarterly value add that I sent out to everybody. If I didn't send it to you yet, I'm going alphabetically through my client list. So if I haven't sent it to you, you're at the end of the alphabet and it's coming to you soon. The other thing is, if I cannot send this to you unless we have a PII form on file. It's a personable permission to disclose personable identifiable information. So just like at the bank, if you and your wife have two different checking accounts and they're in your individual names, if you call and want information on your spouse's bank account and you're not listed on it, they're not going to tell you anything. I'm not supposed to send any information that you guys are not both listed on. So like for IRAs, they're listed in your individual names. I can't send you information about your spouse's IRA unless we have this form on file. So for you guys that don't have that on file, I've been sending out texts and reminding you and asking you to sign. It's literally one click on Adobe Sign, super, super simple. But I will be able to send this beneficiary checklist once all the PII forms are signed and on file. So this checklist here, guys, it's so important to have beneficiaries correct as part of your estate planning. God forbid something happened to you. I mean, we're all going to pass away at some point, and we want to make sure that your money is going where you want it, especially as hard as you're working for it and as much planning as we're doing. We don't want that plan to just be disrupted and not continued on to, continue your legacy that you wanted. So how are assets transferred at death? Number one is beneficiaries. And so that's why, like with IRAs and things, we don't need to put those inside of a trust. We might want to, and I'll explain why we might want to in a second. But we can just put a beneficiary that doesn't have to flow through the trust. It just goes directly to that beneficiary. The trust is a second place. So obviously the trustee is in charge of making sure that they follow the instructions and everything of the person that initially wrote the trust. And then the will is the last place. And the downside of a will, it's better than having nothing, but it does go through probate, meaning that there's going to be attorney's fees. Probate is public information. A lot of people don't like that. So again, that's why I normally recommend that we get your trust all taken care of. Okay, so types of beneficiaries. You can have two different types of beneficiaries. It can be a living person or an entity, but there's primary and contingent. Basically, if something were to happen to the account owner, the next place the money flows is the primary beneficiary. If the primary beneficiary is deceased as well, then it goes to the contingent beneficiary. So that's why it's really important to have contingent beneficiaries, guys, because if you and your spouse are, you're the account owner, spouse is primary beneficiary, God forbid something happened to both of you at the same time, if there's no contingent beneficiary, boom, your money goes to probate automatically. And all of a sudden, all this planning that we're doing, that's obviously not what you want. Nobody really wants their money going through probate. So that's why I wanted to send this out for people that didn't have this or wanted to update. I mean, it's important. Things in life change. So this is a value add that I'll send out every few years just to make sure that everything is continued to be updated as you want. So what I did is I listed out all of your different accounts. Some of you, have one, some might have 7 different accounts, but they're all listed here. Account values, I put the primary beneficiary, who they are, the percentage, how much they're going to actually receive in dollar amounts. The reason I like to put the dollar amounts is especially like for contingent beneficiaries. Let's say you're the account owner, your spouse is the primary, and you have 2 kids that are the contingents, and they're both like 6 and 8 years old, 50% each. The question comes up then, do you want your 6 and 8-year-old to potentially receive $250,000 each? A lot of the times the answer is no. We don't want them to just get a check for that amount of money. So that's when it makes sense to make the trust your contingent beneficiary, because God forbid something happened to you. We want there to be some stipulations and guidelines around how the children actually will inherit the money. Maybe it has to stay invested for 10 years, or they can take out X amount a year, whatever. You get to decide that. But they're, if it goes through the trust and not just to them as individual contingent beneficiaries, then we avoid that issue of money flowing directly to them and not having any guidelines with that. So then at the bottom, I just put different items of considerations for each of you guys on what I found. For a lot of them, just making sure to review bank accounts to ensure that your primary and contingent beneficiaries are correct on all of your bank accounts and employer-sponsored plans, all your 401ks, 403bs, 457s. And then for you guys that didn't have contingent beneficiaries, I just put a little reminder in there like, hey, let's make sure we think about this and potentially add some contingent beneficiaries to help avoid probate. So that's what I have for you guys. Again, I'm going to be reaching out to everybody when I get back from Arizona to start setting up our next round of reviews. But as always, guys, you don't need to wait for the reviews. If you have questions, let's get together, chat about stuff. But we will be reviewing this beneficiary report as well as your specific portfolio performance and all the financial goals that we're working on within your individualized plan. So I hope that is helpful, guys. Rounding out, headed into Q2 here. Enjoy Masters weekend, and I'll be talking to everybody soon. Take care, guys. Bye.